Welcome to Investors Insights, episode 160. Please keep sending us your comments and questions. They help us bring you the information you want. With that said, we have some good information to share with you. So, guys, let's jump right in.
You're listening to Investors Insights with Greg Powell and the Portfolio Strategy team from Five Plan Partners.
Well, guys, it's a new month.
It is.
And so, believe it or not, April was actually a fairly good month, up slightly. The big winner was oil. Oil was up 15.5%. Obviously, a lot of that was the Kuwaiti strike with the oil at the beginning of the month. And then also some more economic reports that came out were, slightly negative. Obviously, GDP came out less than expected last week. And so, obviously, that's not good. GDP is heading in the wrong direction. Then also consumer spending continues to disappoint. And then earnings. 55% of the S&P 500 earnings have come out for the companies. And about 6% decline so far. So, again, that's going to be three quarters in a row, really, of declining earnings. So that's concerning. But, Trey, talk about the GDP report further and also the Fed.
Yeah, so last week we kind of talked about what we were watching. And so we were going to look for a GDP report to come out, and we didn't expect much from the Fed. Well, the GDP report was negative like we expected, 0.5% growth. That's very low. The first quarter of the last few years has been very low, so this wasn't completely unexpected. However, the last few years, there's been big negative weather events that has pulled it down. This year really didn't have that, so it's a little more concerning. How this impacts your portfolio really is economic growth can translate into profits, which the companies with higher profits will push their share prices up, and that's really what we want to see. The trouble is, like you said, that we're getting earnings coming in low, and then if the economy's not growing, what's going to change those low earnings? That's what people have been turning to for the last changes it. You have low earnings growth. What's been pushing the market up? The Fed. Well, last week, as we expected, the Fed came out with no news really. Not saying they didn't raise rates. They left them at a range between 0.25 and 0.5. They didn't pull off the June meeting, but they didn't make it sound like the June meeting, which is their next big meeting, is on the table or off. They just kind of in between. And so there's not much. How does this impact your portfolios? It should keep interest rates low and tied down. But there's not much emphasis to push equity prices on a long term up. You got low earnings, low economic growth, and no more help from the Fed for the next few months at least. So that's kind of how while we were watching it, how it kind of could impact your portfolio.
Yeah, really, the Fed has driven a lot of artificial growth really the past year or two. And so a lot of that can be seen as technology companies.
Yes.
I said earlier that April was a pretty good month, but really technology companies were the big weakness. And a lot of that is their earnings are going down, but their valuations are so high. Part of that valuation problem is because of the Fed.
Right,
and driving artificial growth.
Right.
And so as you talk about the manufacturing number, manufacturing is actually starting to pick up.
It is.
You have GDP and other economic numbers going down. Manufacturing, which has been weak, is actually starting to go up. Talk about that.
It is. Going manufacturing, we feel like we're going a little bit old school this morning because we usually talk about technology, but Bobby's exactly right. Manufacturing in the United States has been contracting since last summer to the end of February. But in March, we had a positive ISM expansion data. The ISM data goes from 0 to 100. Anything over 50, not surprisingly, is an expansion. Anything below 50 is a contraction. We had above 50 last month. Economists think that it's going to get even better for this month we just closed. And why it impacts your portfolio, because we've had some clients ask this, and it's actually an excellent question. Manufacturing employment as a percentage in the United States is pretty low. It's only about 10%. It was 25% in the 70s, and back in World War II, it was about 40%. So we've had questions, well, if the employment is that low, why should we care about that? Well, the answer to that is, and the reason it impacts your portfolio, manufacturing is a big multiplier. They spend a lot.
Right.
What happens is and to Trey's point this morning, our manufacturing has got so much more efficient because of technology and machines that our output is even higher with less workers. But if I'm ordering a part from Trey or he's ordering one from me, it's usually a pretty good sized purchase.
Right.
So that multiplier effect of the economy, it's a large purchase. Also, too, on the employment side, just on that, the other thing that we'll mention too is that direct manufacturing employment is only 10%. But the indirect with the integrated supply chain that goes with it is much larger.
If it's built, it's got to be shipped.
Yeah, you got to carry it. Rail, barge, truck, what have you.
The inputs are shipped in, the outputs are shipped out.
Exactly. So what we noticed is, and the final thing we'll mention to you on GDP is, of course, it was a very anemic 0.5%. A major contributor to that is, even though manufacturing is going back up, it had a 5.9% contraction in what they spent in terms of equipment and buildings. That was about a 0.76% GDP impact. So even though it's only about 10% of the direct employment in the United States, the GDP driver is big.
Very large.
Yeah.
So we, in a very unusual way, if we could get even manufacturing, just, pardon the pun, floor off a little bit, that would really help GDP be stimulated from an unusual source.
Instead of a 0.5% growth, we would have had what?
1.2, 1.3. Exactly.
Growth.
It would have been
drastically
anemic.
different.
It would. It would have been anemic, but it's much, much better than what we had.
Yeah. Well, as you can see, we're analyzing a lot of information and how it relates to your portfolio specifically. And also, please give us a call if you have any questions. We thoroughly enjoy talking to our clients on the phone and in-person meetings. So let us know if you have any questions. So thank you for watching and have a great week.